Hello, this is AJ Polanco. I recorded this presentation on Johnson & Johnson as part of the pharmaceuticals team's presentation. J&J is predominantly broken into pharmaceuticals, medicinal and diagnostics, and consumer products sectors. J&J's ticker is J&J. Its stock is part of the Dow Jones, and the company is listed among the Fortune 500. Among their most popular brands are the ones listed here. The main point that I would make here is that with the exception of baby shampoo, there are few sub-brands that use J&J's name. This is a very conscious business decision so that the failure of one does not cause the failure of all. This idea is best exemplified by the J&J survival of the 1988 Tylenol cyanide scare. For the pharma sector, what I want to call out were two different subsections, immunology and oncology. Immunology, through the merits of accounting for 33% of pharma sales, provided the most support for this business segment with an increase of $1.2 billion in sales. Oncology achieved a sales of $3.8 billion or a $1.1 billion increase due to a returning supply of one of their products called Calyx. Whether this supply will have an effect into 2014 is uncertain based on what I found in the 10K. That said, I found it to be a sector worth mentioning. For medicinal and consumer, I don't want to spend too much time on this sector, but what I will mention is that the orthopedics franchise achieved the sales of $9.5 billion in 2013, and this was predominantly due to an acquisition of Sense Incorporated and taking in a full years of recorded sales for its joint reconstruction products. With OTC, there was a marked increase in the percentage change from 0.7 in 2011 to 2012 and 7% in 2012 to 2013. For the income statement, between 2011 to 2013, I saw that there was a significant increase in sales. Similarly worth noting is that expenses grew at a slower rate than sales, which accounted for a strong increase in net income. This combined with paying less income tax due to foreign acquisitions allowed the earnings per share of J&J to increase from 2012 to 2013. In terms of the balance sheet, total assets saw a drop in 2012, which was then reversed in 2013. From this sheet, I took notice of the fact that the total liabilities was not readily impacted by the change in total assets. And for any matter, total equity saw a continuous increase from 2011 to 2013. Lastly, in analyzing Johnson & Johnson's net earnings, I want to call to attention to the fact that there was a negative change in cash and cash equivalents in 2012, and if not for the massive repurchasing of stock, the change in cash would have been positive. In looking at the 10K, I found that the repurchase at this time was driven by the acquisition of Sense, which was the company that I had mentioned earlier, and I'm making an assumption that continued success with Sense will continue to drive an increase in cash and cash equivalents for the years going forward. For ratios, the main ratio that I wanted to highlight was net income over sales. As a concluding note, I found that Johnson & Johnson was able to increase its profitability throughout the 2011 to 2013 period. I believe this to be the direct result of decreasing the percentage of sales devoted to cost of goods sold, SG&A expenses, and income tax. If any of you have any questions, feel free to ask my teammates for my email address, and I'll get back to you as soon as I'm next able. And with that, I'll pass off my presentation to my next team member.